Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more content like this, please visit adisa.org and check out the resource library. My name is Greg Mausz. I'm your host today. I'm joined by Douglas Blake, the Managing Director of Investment Solutions at Kingswood U.S. Doug, thanks for coming today.
Thanks for having me, Greg.
We're going to be talking about the life cycle of an alternative investment. So before we go any further, can you unpack that title for us?
I think at the broker-dealer level, so much emphasis is placed on the subscription process for an alternative investment. But there's so much more to the journey of that investment, starting with the product sponsor that wants to create the right product to sell to the market. Then going to the due diligence process, the broker-dealers and RIAs determining whether or not this product is right for them. Then the distribution process, figuring out how to distribute this product to the investment community, how to distribute the product internally within the broker-dealer. Then the custodial solution, where to put it, how to hold it, who will hold it, who won't, what types of accounts can hold it, what types can't. And then the follow-through, the monitoring of this investment, and eventually, at some point, potentially the exit.
And then I'm also the communication all along the way, that they're communicating with the financial advisor and the investor of what's going on in good and bad markets, right?
Absolutely. I think one of the best ways to determine the state of an industry is to look at the alternative investments within that industry, because unlike securities, whether they be stocks, potentially bonds, that might also be linked to Fed policy or the interest rate environment. Alternative investments are a really pure way to get access to these different sectors in the economy, so they wind up being pretty good indicators of the economy as a whole.
What makes this such an interesting topic for you?
Good question. I am very passionate about alternative investments. I have been for a long time. I can see that. But one of the reasons that I think I'm so passionate about this part of the process or this conversation is because I was given the privilege, the challenge, and the task of building an alternative investment platform at our firm, Kingswood, from the ground up just about 5 years ago. So this is an industry that has undergone a lot of change, both internally and externally. Everything from the products themselves to the advisors that sell them, to the different regulations that have come to the industry to sort of support this asset class. And to build a platform today versus the ones that existed 5 years ago, 10 years ago, is an entirely different mandate. So it involves everything, as I described, from the due diligence process to the custody, and of course the subscription process in the middle. So I think that's probably where this passion comes from.
I completely agree. And why is it so helpful for the industry to take this kind of holistic or global view of an investment?
So we are the ill-fitting sibling to the other investment vehicles that are out there. Of course, stocks, bonds, mutual funds, ETFs, things like that. They're liquid, they're fully registered, they're well within the regulatory scrutiny of the exchanges, of the SEC. Whereas these types of products are definitely the counterculture. They're smaller, they're niche-y, they enjoy different types of registrations that give them certain exemptions, but in many cases they're not appropriate for all investors. So it's an interesting opportunity to deal with these types of products that don't necessarily fit with the mainstream. And the reason I call it an opportunity is there's certainly a place for this asset class, but I don't think it's found a home in wealth management the way that these other verticals have. And I think that's, when I say opportunity, that's what we can do if we don't just focus on one component, what we need to solve for as a broker-dealer, what an investor is trying to accomplish by investing in this program, what an advisor is trying to accomplish by recommending these types of investments. But if we actually focus on every stage in the cycle of an alternative investment, we can actually make it look a lot more like the stocks, bonds, and mutual funds that it sits next to, and then eventually potentially get a little bit more of a widespread adoption to this wonderful asset class that's certainly underrepresented.
Well, and it's so comprehensive. You just mentioned it. There's multiple structures, multiple asset classes, sub-asset classes. There's just a lot going on. So it is taking time to kind of work through all that and drive advisor education so that they understand all of these nuances, because it's the underlying asset class, but then it's the unique features and benefits of each vehicle, the tax reporting that comes from that. So there is a lot of moving parts there. So considering all those moving parts, how do you structure your alternative investment offerings at Kingswood?
It's a great question, and you really touched on probably the most important component to selling these the right way to the right clients for the right reasons. Mm-hmm. It comes back to communication, and it comes back to education. So first and foremost, these can be pretty complicated structures, but the litmus test is, can the client explain to you what they just bought? And the process of getting that information from the sponsor to the broker-dealer, to the advisor, to the client, it's like that game of telephone. Mm-hmm. There's a lot of room in there for things to be translated or misinterpreted. And then you wind up in a situation where the product you sold is not the product they bought. And obviously, the industry, the regulators, we've gone through great lengths to mitigate the risk of that.
Right.
But it's still present. Education really is at the forefront of how we correct that lost in translation phenomenon. So we utilize resources like AI Insight, which is part of iCapital, and it allows our advisors to do their own due diligence on these programs before they sell them to their clients and prospects. Clients and prospects are also getting materials there that they should be utilizing to learn more about these companies as well. So those are sort of links in the chain, the custody of information from the sponsor to the investor, that are really critical. Our job, to answer your question, at the broker-dealer level, is to make sure that the platform is transparent, that our reps and advisors know how to find these products, what they are, how to use them. They have a certain trust that we've gone through the due diligence process to vet these products before we make them available to our advisors. That's not something we take lightly. So you've probably found in the industry, the due diligence process is just getting more and more intensive and extensive as we go. And then we also need a platform for transacting this business that is user-friendly and that is efficient, because so much of this already complicated industry gets overcomplicated by all of those other variables that we discussed, like the custodians, like the workflow process, like the different types of subscription agreements from the different managing broker-dealers. It all creates a really complicated structure that you sort of have to standardize at the broker-dealer level so that your reps can use it efficiently and convey it to their clients efficiently.
Right, and I think that the sponsors need to create the marketing materials, the brochures that eliminate some of that telephone problem that you have, right? So it's a brochure or a point of sale piece that the financial advisor can get educated on, and then mirror that right back to the investor, so that the investor fully understands what they bought. And these marketing materials, have all the disclosures, but all of the key terms, and it's clear on how do I get in? How often do I get my payments? How do I get out? How is this valued? How is this reported? Those are some key foundational points, and it's not that hard to put that and to kind of get that consistent message all the way through the food chain there.
Absolutely, and that's one of the biggest epiphanies I think I've had in the last few years. Of every alternative investment product out there, you're going to ask those questions, right? And your clients, most importantly, those are the questions they're asking. What is it? Why would I invest in it? What can go right? What can go wrong, right? What's the upside? What's the downside? And those questions you can answer for just about any program that you offer to a would-be investor. But there's so much more to due diligence than that. And that's actually your responsibility. because the client, although they should educate themselves on these products, they may not take the time and have the time to go so deep into those other inner workings of these programs to understand whether or not they're going to be the vehicle to address their need and whether or not they're actually going to get where they say they're going to go. So a lot of that falls on the advisor, on the BD, and even the sponsor to structure these products in a way that by the time they get to the end user, the investor, all he has to ask is, what is it? Why does this fit my portfolio? How does it work? What's the upside? What's the downside?
Yeah, 100% agree. There is constant innovation going on in the space, which is great. Advisors are saying what they need. Asset managers are trying to respond. Out of some of this has come interval funds and tender funds. And more are being created all the time, tackling growth challenges or income challenges, or they're doing real estate or credit or a combination of both. What do you think about interval funds, tender funds, and their future, and how that's fitting into this whole conversation?
So this is definitely where things are headed, and I think there's a lot of reasons for that. If you look at the evolution of the financial services industry, even in just the last 10 years, clearly everything is pushing towards registered investment advisors, fee-based business, passive strategies to aggregate assets under management. And the advisors want as little human intervention as possible, it seems, which may not be the worst thing in the world. With automation, with standardization, you wind up with a very efficient, very predictable, a very low-cost structure that just about any would-be investor can participate in. And they could reasonably expect that whatever it is they're looking to achieve, that they'll get there with some predictability and with relative stability. When you introduce alternative investments into that equation, you wind up with a product that is not as transparent, that is not as liquid, that is potentially more volatile, certainly more volatile than broadly diversified strategies. And so how do these asset aggregators that are just growing into the trillions every day incorporate this strategy into an otherwise standardized, homogenized pool of assets? Well, make them look similar to the other assets. So maybe I can't give you daily liquidity, in some cases you can, or instant liquidity like with a stock or a bond or a crypto asset. Mm-hmm. But I can give you, under certain circumstances, quarterly liquidity. And I can give you a stated value that I will reassess on a regular basis so that you can actually report to your clients a fairly accurate depiction of the value of the asset that they're holding. Now we're starting to look a little bit more like stocks, bonds, and mutual funds. So even though they maintain some of those attributes of those non-correlated assets that the advisors who recommend them love so much, but now they enjoy some of the attributes of some of the more liquid strategies that I think are a lot more friendly to today's wealth manager.
Thank you for that. You have been in the financial services space for quite a few number of years. What are some of the best practices that you can convey when advisors are implementing alts into a client portfolio?
It's a great question, and two things are happening at the same time that I think had to happen for this industry to evolve in the way that it has. One, the products are maturing. Products that were a lot less transparent and maybe a lot less investor friendly in the past have now really evolved to the point where they're a lot more geared towards the advisors making great recommendations and the investors having a great investment experience. The other thing that has happened is that advisors have really educated themselves on these products and on these strategies. And even the advisors at my firm, we're not doing alternative investments for the sake of doing alternative investments. It's just there's too much at stake, to just try to incorporate an asset class for posterity. We're utilizing alternative investments for specific strategies, for access to asset classes that aren't otherwise represented in the public markets. or for advanced strategies and planning where other assets just don't do the job. So the advisor has evolved, the product has evolved, and it's created what I think is a drastically different and far improved industry from that perspective from the one we saw 10, 15 years ago.
I've seen the evolution of advisors every year. More and more of them are using alts. More and more of them are using it the right way. And I agree, there's a higher quality of alternative investment now than there was 10 years ago. So, Doug, thank you for walking us through this conversation and the life cycle of an alternative investment. Really appreciate it.
It's my pleasure. Anytime.
And thank you for watching another episode of Focus on Alternatives. Again, for more content like this, please visit adisa.org. Thank you.